What's going on, YouTube? I trade here with a little technical analysis for all you technical analysis traders out there, I guess. I'm going to use DOGECOIN. If this is your first time tuning in, please consider subscribing. If not, just share the video to somebody and like the video. Now let's jump right on into this one. Let's bring up some... Actually, before I jump into that, I want to go over a few key... terminology for you guys and girls out there that you need to know, because it's not just about using moving averages and other technical indicators. So I'm going to go over the three that I mainly use. Oh my god, look at DOGECOIN, it's falling. Where's it at? That's nice though, it's good. I like seeing it do that little I'll go over that later. That's a good little red candle right there. I like that. Alright, so the three I use moving average, I also use RSI, and I use DMA. Okay, I'm going to go over the MA first one. The MA is moving average, okay? Moving average is a statistic, a moving average is a calculation. In statistics, a moving average is a calculation used to analyze data points by creating a series of averages of different subsets of the full data set. In financial, a moving average, MA, is a stock indicator that is commonly used in technical analysis. The reason for calculating the moving average of a stock is to help smooth out the price data by creating a constantly updated average price. Hence, moving average, because it's always updating with a moving average, because it's always moving. It's never the price isn't gonna stagnate and stay still, so it's always up and down. Or even if it's sideways, the price isn't gonna stay at the same. It's gonna go up a couple cents. So by calculating the moving average, the impacts of random short-term fluctuations on the price of the stock over a specified time frame are mitigated. Key takeaways: a moving average is a stock indicator that is commonly used in technical analysis. The reason for calculating the moving average of a stock is to help smooth out the price data over a specified period of time by creating a constantly updated average price. A simple moving average, SMA, is a calculation that takes the algorithmic meaning of a given set of prices over the specific number of days in past, for example, over the previous 15, 30, 10, or 20-day moving average. Exponential moving averages, EMA, is a weighted average that gives greater importance to the price of a stock on more recent days, making an indicator that is more responsive to new information. Understanding moving average. Moving average is a simple technical analysis tool. Moving averages are usually calculated to identify the trend direction of a stock or to determine its support and resistance levels. It is a trend following or lagging indicator because it is based on past prices. The longer the time period of the moving average, the greater the lag. So a 200 moving day average will have a much greater degree of lag than a 20-day moving average because it contains prices for the past 200 days. The 50-day and the 200 moving average figures for stocks are widely followed by investors and traders and are considered to be important trading signals. Always remember the 50 and the 20 and the 200 day. I use those ones too, but I also use another one. Moving averages are a totally customizable indicator, which means that an investor can freely choose whatever time frame they want. And when calculating an average, the most common time periods used in moving averages are 15, 20, 30, 50, 100, and the 200-day moving average. The shorter the time span used to create the average, the more sensitive it will be to price changes. The longer the time span, the less sensitive the average will be. Investors may choose the different time periods of varying lengths to calculate moving averages based on their trending objectives. Shorter moving averages are typically used for short-term trading, while longer-term moving averages are more suitable for long-term investors. There is no correct time frame to use when setting up your moving averages. Remember that. I don't care what anybody else says. This fool can say, oh, well, the 10-day one is the best one. And I can say, well, the 20-day moving average one. You know what? Hey, you got to remember that they're not just using, and I'm not just using only one indicator. You'd be a damn fool. I mean, I hardly ever even use my indicators. They're just on my screen all the time just so I have a point of reference. Okay, so a rising moving average indicates that the security is an upward trend, while a declining moving average indicates that it's a downward trend. Similarly, upward momentum is confirmed with a bullish crossover, which occurs when a short-term moving average crosses above a longer-term moving average. Conservatively, downward momentum is confirmed with a bearish crossover, which occurs when a short-term moving average is below a long-term moving average. Let me switch over and show you what they're talking about. We got our boy Deutsch right there. I like this little red Kindle right here. It was nice. I'm pretty sure everybody else was like, okay, so let's go over to the 1 hour. Let's see. See, like right now, I use the 20-day moving average. Actually, you know what? I don't want to get you guys. Don't look at these ones. Okay, we're only gonna worry about moving averages right now. Okay, so my green line is the 20-day moving average. So let's go over to the 30-minute one. I mean, obviously, when you switch over to different time frames, you're gonna see different. It's gonna give you different readings. So don't always like. I made this mistake before, where I'm like, I'll forget. I'm only on the 1 minute one, and it's like, oh man, you see that one? That candlestick is wild. But like looking at this one doesn't look like it's like it's my criteria right here. So like if I go to the 5-minute one, it actually just met my criteria if I want to do a short-term game, because I have the 20-day crossed over the 50-day moving average, and I have the 200 moving day average. So like if I have the 200-day moving average down here to basically warn me, like once we start touching this 200-day moving average, I need to start planning an exit. You know what I mean? Like I'll explain that later on how I determine it's not just once the price hits that this line right here where I'm like, okay, I need to start planning. No, it's a series of reactions or effects that happen that I need to do a reaction on. You know what I mean? Every action has a reaction in a way. So I'm watching this to see what action is doing. I'm like, well, how am I gonna react to this? That's all we're trying to do. That's what this all is technical analysis. We're going to be like, well, how am I going to fix this? I mean, this works great for me. I used to be an automotive technician. I mean, I use data all the time to diagnose vehicles. So I was just trying to determine this in a way that makes sense to you. So let's continue on over here. Okay, so the rising moving indicates upward trend and all that. While calculating moving averages are useful in their own right, the calculation can also form the basis for other technical analysis indicators such as moving average convenient divergence, the MACD, which that's this one right here, the MACD. I throw the MACD in on there too. Okay, so let's go. The moving average, the MACD, is used by traders to monitor the relationship between two moving averages. It is generally calculated by subtracting a 26-day exponential moving average from a 12-day exponential moving average. When the MACD is positive, the short-term average is located above the long-term average. This is an indicator of upward momentum. When the short-term is averaged in below the long-term average, this is a signal that the momentum is downwards. Many traders will also watch for a move down or below the zero line. A move above the zero is the signal to a buy above the crossing signal. So I'm just going to show you guys right now. So zero is right here is what they're talking about. This would be zero. So right now, we're actually getting ready to shoot up an upward trend by looking at what we have here. This, let me get further out. I hate looking at the short. I don't know how people could sit there and look at the 1-5. It's too stressful for me, man. I'm like, give me the 30-minute one and I'm good. I can make some stuff happen with the 30-minute one. You just go back and see like just how it's been. I mean, let me show you guys how it was on a pretty nasty day after we ran it up. Okay, so that's not gonna work. Let's see. Let's use this one right here. Alright, so right here you can see we had a pretty significant drop, which dropped down to 0.006. The low is 0.007. But then if you come over to the high, we're sitting at 0.0024, which is significantly, that's huge. That's the MACD. That's a lot. So I mean, it's kind of hard to explain. It's just like when I see it, I know what I'm looking at, and I'm just trying to show you guys too. Like, look at this. When you see it, you know what kind of action, what reaction you're gonna do. Come on, baby. Hey, we're going the wrong way. Excuse the noise. Neighbors just moved in, and I guess my room isn't isolated enough. But I mean, let's go back to the 5-minute one and see. Like you see what I'm talking about right now. Like we're getting ready to cross back over, and we're gonna go back upward. We're continuing in an upward trend. So let's continue on this. Okay, so we got types of moving averages. We got the simple moving average. Simple moving average, known as SMA, is calculated regular. I don't use that one, so we're just going to continue. Let's just get down to the moving average one. That's what I use. I mean, okay, the moving average. Moving average is calculated differently depending on the type of SMA or area below. We look at simple moving averages as security follows the price. Example, moving average indicator, boiler bands, standard deviations, oversold, and all that. Okay, that's not helping you guys. This is why people get confused on crap like this. Okay, and now let's go on to the next one that I used. The next one I used is something that is called the displaced moving average. It is a DMA. What is a displacement moving average? Displacement moving average is with a moving average. Okay, anytime it's a displaced moving average is a moving average that has been adjusted forward or back in time in an attempt to better forecast trends or better fit price movement of assets. So back to the 30-minute one. I want to show you guys more. We can see more. Like, okay. A displaced moving average is any moving average that has all its values shifted forward, positive displacement, or back, negative displacement in time. Investors can choose to shift a daily moving average so that it better aligns with higher or lowers in price. A better contains or fit the price. That better fits or contains the price. So what you want to do is just come over here, and we're going to switch this up. I want to throw this one over to the 20-day. That one's going to be the 50. Actually, no, this one's going to be 100. And then the mid one is going to be 50. That's better. So now it gives me a better idea of what's going on. Now I'm showing you guys how to go in and set it up and all that. Okay, so this is my moving averages. Well, it looks like I already set this one up. So I got my 20, I got my 50, and I got my 100. The reason why it's different than this one down here is because this one obviously doesn't offer you the 201. And like I said, the 201 is just basically let me know, like, all right, my reaction needs to be, I need to start planning my my way out of this if I'm not going to continue to stick long term in it. Okay. Okay, so now how the DMA works, basically. Let me give you a quick one. All right, the DMA doesn't require any calculation beyond the moving average calculation. Each value of the moving average is a moved forward or backward by the number of periods determined by the trader. For example, assuming the trader wants to displace their moving average 3 periods into the future, the current moving average value will be placed 3 periods into the future on the chart. The prior period's value will also be placed 3 periods into the future. What does the displacement moving average tell you? That all this tells you basically it gives you basically like the trend direction. In general, helps determine trend direction when the price is above the MA. That helps indicate an upward trend, or at least the price is above the average continuously when the MA. That's why when you guys came on, you didn't really, it wasn't on. I had my RSI, and I believe that was it. That's basically what I used to continue to support my strengths on this one. I used the DMA one for when I'm entering it. VWAP, obviously I don't give it VWAP on this one. So looking at this chart, let me explain what the RSI, because the RSI is very important in my opinion. Now remember, I'm not a financial advisor nor financial expert at all or in any which way. You should consider this entertainment use only. Consult with a professional before you buy or sell any asset. Or hell, don't be lazy. Look at some charts, read some articles, listen to some random guy or chick on YouTube. Now, the RSI is a relative strength index. RSI is a momentum indicator used in technical analysis that measures the magnitude of recent price changes to evaluate overbought or oversold conditions and price of a stock or asset. The RSI is displayed as an oscillator, a line graph that moves between two extremes and can have a reading from 0 to 100. The indicator was originally developed by some, I don't know about that. Well, now what it means when it says it is a it's an oscillator, that means it has its own graph down here. It's not like a moving average or simple moving average or the daily moving averages. I mean, or these other ones where they're going to be involved with the chart. They're built into this chart. This one's going to have its own separate spot. So traditionally, the RSI, if the values are over 70, or above, indicates the security is becoming overbought or overvalued and may be primed for a trend reversal or correction pullback in price. An RSI reading of 30 or below indicates an oversold or undervalued condition. So usually rule of thumb with me is, let's see, where was it? Where did I jump back in on this one? I jumped back in on Deutsche. Well, I've always been on Deutsche, but I actually wanted to start playing this one as a swing trade kind of deal. But it was right here. It dropped down to, I believe, 20, below 20. And one of my main criteria that I always go by when I'm entering, and when I'm entering an asset, is if the RSI needs to drop below 20. I mean, 30 is like, all right, like there's a lot, but once you get below 20, then I mean, you're primed for takeoff again. I mean, given that we did drop back down again over here to 23 is not nearly as far as, what was it, 17, I think? No, it was like 18. It hit 19 something, I think it was. It was right below 20, which was, man, I was like, hell yeah, I'm buying a shitload of DOGECOIN. And I was actually going to sell out right here, but I forgot why I continued to hold on to it. I just seen something and everybody was reacting to it, so I was like, well, what am I going to do? Well, I mean, that's pretty much all I got for you guys real quick. I mean, it's not that hard. Anybody can do technical analysis on DOGECOIN, basically. I mean, you just come in and look, let me zoom out. I'm going to put it on the 1 hour one. Well, hell, they don't show you that far back on this one, do they? Let's go to 3 months. But, okay, right here, we can basically see what this asset has been doing. Let me get a better picture. Come on, baby. I got this new mouse, and it's just a whole lot different than using the Apple one. It's this MX Master 3. It's nice, but I need to get a trackpad to work with the Mac. But, come on, zoom out. It has this little button where you can lock in the zoom, and then you can unlock it, and it free spins. So it's some pretty badass bearings inside of it. But you see here, we had a consolidation for a long time, and then we finally ran up. We consolidated. We ran up again. Had a little consolidation period, ran up, and then we had a downward trend, which is always healthy, okay? Don't ever think that it's not healthy to have an asset come back down. And then look at, we had another consolidation period where it was setting higher highs, lower lows, and then boom, popped. And then we settled down, reconsolidated again. And then this last run up here has been amazing, because look at, there really hasn't been any consolidation period here. It's just a very small, very small amount of consolidation. The RSI has been holding steadily above 40. As long as we don't drop below 30, for me, RSI is good, because I mean, that's fine with me. But I mean, we got another nice bull flag going on over here. I mean, people keep asking if you should invest. I mean, why shouldn't you invest? You see what this thing's done? This came from nothing. I mean, my average cost on one of my portfolios is 0.004. Okay, that's not even a penny, bro. It's not even a half a penny, man. It's like, what the hell? How is that even possible? Okay, and I put like $1,000 in it, and it's doing nice right now. Okay, I wish I'd have put more into it. So, I mean, if you find this video useful or even entertaining, that's what I'm going for. Entertainment would be better. Comment, smash the like button, smash that subscribe button, smash everything, god damn it. I'm out, baby. Let's go make some more money. Deutsch to the moon.